welcome to the three of you. Let me just very briefly introduce you. Frank Meijer, you are Global Head of Alternative Fixed Income and Structured Finance at Aegon Asset Management. Jesus Rio Cortes, your partner at Apollo Management International LLP. And Emmanuel Issanchou, to introduce you as well, you will be moderating this event, Head of Global Markets Americas and Global Head of Credit Markets at Natixis CIB. The floor is yours.
Thank you very much. Thank you, everybody. Look, it's the last session of the day before we break to nice cocktail and like a beautiful weather. So we'll be efficient, short. I'm very happy to have you guys. I think it's going to be a fairly interesting panel, and I would like to effectively cast a different light relative to what we've heard today. For one very reason, you guys, are investing a lot for big, I would say, insurance balance sheets across, effectively, US in Europe. And I want to share a few observations. The observation, actually, I was about to ask, like, the question has already been answered in some ways throughout the day. But the more I've heard about the day, the more I'm like, well, all that is very good, very interesting, but let's be a little bit provocative here. It's a different, definitely, macro backdrop, number one. Number two, clearly, we're talking about like a huge opportunity as far as the market is concerned, the size of the market, the scalability. I will start with that. Supply and demand. Everything has been said right now. It's effectively the source of capital and effectively the demand of the asset. The one thing I see, and maybe you experience that as well, is scarcity of the asset. The world is deleveraging. We talked about M&A, we talked about the private equity, we talked about even the consumer, the household. So the supply of assets is very scarce. So question is how to deploy in a sound way without taking more risk on balance sheet, without chasing and deploy capital, and effectively chasing and compressing the famous, infamous illiquidity premium. What does that mean for that? What does that mean in terms of we want to trade private assets? What does that mean in terms of do we still have a liquidity premium? What does that mean in terms of the mark to market of your balance sheet? So I see a lot of interesting discussion and development of the market, but at the same time, a lot of perceived contradiction. So I want to kind of take this stance for the last panel as opposed to, restate what we've already, it was very insightful, by the way, shared by our panelists. So I guess the first question I have for you guys, of course, Apollo, Athene, Athora, Aegon, you've got two different type of balance sheets. At the same time, it's insurance companies. What is your investment model and how you would differ from, I would say, your positioning? Jesus?
Yeah, thank you. I would say it's interesting how Apollo came about. Apollo 10 years ago was a private equity firm, basically a tiny credit business on the side, but a private equity firm. And what they did was to transition into, okay, we're a private equity firm, but why don't we buy insurance companies that can generate attractive liabilities, pension liabilities, life insurance liabilities, and then we can deploy these liabilities into interesting assets. So we can do better than other insurance companies are doing, which is what gave the rise of Athene in the US, which is now close to 300 billion AUM, Athora in Europe. And when you think about the current AUM of Apollo, it's basically 2/3 is credit. Private equity is less than 1/6 of the entire AUM of Apollo, which I don't know the latest figures, but it's around 650. So there's been a total transition. Now, within this view of, okay, let's find the insurance balance sheets, the next thing was, let's find the assets for the insurance balance sheets. So, Apollo decided, let's buy whole loan portfolios, let's buy QSIPs in the market whenever we find them, or let's buy the factories that can manufacture the assets that we want, because sometimes there's value in controlling the underwriting box, there's value in controlling the pricing policy, and I want to be able to design a product that is going to be exactly what I want to invest in. Plus, it gives me the strategic ability to source these assets in good times, bad times, whenever I want to. So that's something that I think is quite unique to Apollo, perhaps, in the sense that we have been looking into building all these platforms. We have now 16 or so platforms in mortgage lending, in auto or vehicle fleet in equipment leasing, in aviation, in trade receivables, in consumer loans, anything that you can think of, but not everywhere. So in certain places, they say, we don't want to have a platform. We prefer to partner with some of the originators there because the underwriting is sound, the pricing is good, and we like to just get a flow. In other places, we say, we just want to buy this company and then manage that to our specifications, which I guess may be different from what Aegon may be doing.
Frank, in that vein?
Yeah, in a sense, I think we come from a different point than Apollo. I would just call Apollo an asset manager that essentially became an insurance company. Probably they don't have to do any fundraising anymore. They buy 30-year liabilities and they are done for the next 30 years in fundraising. I think we have essentially the more traditional model where we are indeed an insurance company from nature since 1800 something. Both indeed insurance company in the US and in Europe. Our model is more, we were an asset manager for only the insurance company when I was young and started working for Aegon 20 years ago, essentially sourcing assets for the balance sheets that actually work. Now we transform more and more into a third-party business where we essentially do probably similar things as Apollo is doing, but we basically start with what we do for our own balance sheet. We now start to distribute to third-party clients, so other insurance companies and pension funds that probably have similar needs as we have. And I think also compared to some traditional or non, I would say insurance asset managers, I think we speak like Apollo. I think we know everything about Solvency II, we know everything about NAIC regulations. So talking to other insurance companies, I think it helps a lot if the asset management arm absolutely knows exactly what a insurance company is all about, how they think about risk, how they think about capital, and actually what does it take to get an asset class through the credit committees and add it to the mix. But again, we might talk about it in a second. So what we do is, well, a couple of things I would say in the big time, at least my team is doing. So residential mortgage lending, I think, came across here a couple of times. So Aegon was also in the old days a relatively small mortgage provider. We had 200 people in our mortgage team and that did mortgage lending like a bank, but only for their own balance sheet since I think the 1930s or 40s, so at least since a long, long, long time. At some point, and I was actually doing ABS, I'll come to that in a second, it didn't work on the Solvency II. I say, what do? I do my job, or what else can I do? So you look at Solvency II and you say mortgage lending outright is the best thing ever on the Solvency II. So basically I set up a model together with the insurance balance sheet, say that we originate also now on behalf of third-party clients, so say you produce it with 200 people, and we set a fund up that we can sell to third-party clients. And that has been indeed a massive success. So far we have gained about 42 billion of third-party investments. Unfortunately not PIMCO, that apparently has 10 billion, not with us, or AXA, sorry. But we have 42 billion of other third-party clients. So that is something that we set up, and actually obviously gives a nice fee business model. So in that sense, slightly different from what Apollo is doing. Other things where you're huge in, we might come to is ABS. Again, so that's something we set up with the insurance company, but now we have also 20 billion in third-party money in that regard. So I think that's also attracting a lot of money. Not insurance companies, but mostly pension funds, to be honest. But again, also direct lending, obviously topic of today. More things we do there, set up teams and also have control over the asset that you originate. And a little bit akin to what Apollo is doing, we also looked at platforms like in the UK, for example, Azopa or Funding Circle, or here in Paris, we were one of the first institutional funders of Zopa, of United Credit, so anyway, we do similar stuff, but again, we also want to have control over assets, obviously important for the risk for our own balance sheets, but again, we always want to lever it to also being able to sell to third-party clients, and that also means we focus on some stuff. That is also a change in our business model. In the old days, we did everything ourselves in-house. I think that model is gone. I think you have to be good at some things and also realize other people are better in some other things. So our insurance company is now a bit more an open architecture that many things that we do well, we do in-house. And again, also third-party clients and other things. There is a other team that would outsource asset management to other asset managers to get the best assets on the balance sheet of our life insurance companies.
Thank you very much. So over the years, what is like, because Khalid and Christian, they mentioned, potentially, you can go up to 40% of within the fixed income allocation in insurance companies' balance sheet. What do you say would be your current allocation? And I guess depending in Europe, US, and what is the target? If there is a target or if there is an optimal number, but like think of, let's say, 80% plus is IG fixed income in insurance balance sheet. what do you think should be the right threshold?
Look, I wouldn't say there's any magic number. We certainly think that direct lending has a lot of interesting attributes, and we lean in our allocation into this asset. I wouldn't say what exactly the number is, but it's certainly the majority of what we do. And that's what we typically do when we acquire other insurance balance sheets that we take into Athene or Athora. We tend to balance the allocation into more the direct lending. I mean, because one of the things that we see with direct lending is when we think about it intrinsically, in our view, we're being paid a premium for liquidity that probably would not need to be there. People tend to think, well, liquid assets, you can trade them, you can sell them, you can buy them, that gives you liquidity. We typically say that there's a bit of an illusion of liquidity. In a good market, you can do all those things. But when you really need the liquidity in a bad market, the liquid assets are as illiquid as the illiquid assets. When you have the LDI crisis in September 22 and you try to sell, nothing would sell. No matter how liquid or illiquid it was, it's all equally liquid in a bad market. So in our view, we're being paid for that premium for an asset that, when you need it, it's going to be as illiquid as the others.
Yeah, let me start slightly different. So why does our insurance company, and I guess all our third-party clients as well, invest in more private credit? I would say there's essentially 4 reasons for it. The first one obviously is more yield than in the liquid markets they have invested in since ages. So there needs to be a yield pickup. And especially when the yield was negative on liquid fixed income, you can't run an insurance balance sheet on negative yields. So they were kind of pushed into private credit to essentially have positive returns. So that was obviously the big driver of private credit, I would say, the last, decade or so. I think the second reason is diversification, because if you look at liquid markets, there is a couple hundred names you can invest in. So there's not that many listed and tradable securities. So at some point you want to have other names in your portfolio than only these 200 or 300, and you have only 27 governments. Looking at private markets, as we know, I think it was mentioned here, so there is millions of private companies that need financing. So obviously from a diversification perspective, it makes a ton of sense to invest either in private corporate loans or in asset-backed securities where you have retail customers and then Carlos as your counterparties. So again, what's not on your balance sheet if you only invest in traditional fixed income. So that has been a big driver as well. The third thing, and that's a bit surprise to me, the word hasn't fallen yet, ESG and impact. Public markets, very hard to achieve, I would say, impact. Yes, you can exclude all kind of bad companies. You say, I don't want to invest in oil and gas and minerals and so on, great. But to do positive with your money, I think it's more difficult to achieve in liquid markets. Private markets, finance wind farms, great. What we also do, for example, is financing governments privately, where the loan purpose is building some schools, hospitals in Africa, for example. And there's obviously many other examples also in corporate lending, where you can actually finance companies and actually do good with your money. And especially if you have also ESG targets and registers in your loan documentation, you can make a company better and more sustainable. And that's what many people like, especially in the Netherlands, but I think across Europe, it's a theme. And the last thing, and maybe also one of the most important things, is just the efficiency on the Solvency II. Solvency I, for the guys in the room that don't know it, very simple. One capital charge for everything you did. If you buy equities or sovereign bonds, didn't matter. You get the same capital amount to hold against it. You were only scared about the S&P rating, that you still have a AA or single A insurance company. So you can't put that much in equities. Solvency II is more like akin to Basel, so you have an RWA essentially for every asset that you hold, and like an any regime change as winners and losers. I think a couple clear winners is government bonds, obviously politically driven. Governments want funding, so if you make it very cheap for insurance companies to hold it, you will have the appetite for government bonds, so they're a clear winner. ABS, a clear loser, so seen as a scapegoat for the financial crisis. €1 in a nice CLO AAA, you have to hold 60 cents in capital, give or take. In the funds that we run, you have to hold 1-to-1 capital, which completely is bollocks, but I guess nobody lobbied against it. So it was a scapegoat. Winner again, residential mortgage outright. So buy an RMBS, you're kind of not great on the Solvency II. Buy the whole loan, take more risk, it's great. You have 1 to 3% capital SCR. So again, probably one of the best things you can buy in the market with the best return on capital. For private markets, generally speaking, corporate private, I'm not talking about, it's not rated. Not rated also pretty well treated on the Solvency II. So you have to hold 3% times spread duration as your capital. So a 5-year private loan might be single B. You have to hold 50 cents in capital. If you make LIBOR 6%, you make a very decent return on capital. So optimization on the Solvency II models, what everybody does, obviously drove a lot of flows into certain asset classes and also actually a lot of flow outside other asset classes. Last thing, I think I take too much time, is in the UK you need matching adjustment, and that also makes it a bit more difficult for private markets because again the cash flows are not that certain, everything is prepayable, so there is a bit more structuring needed, and that makes it a bit harder for UK insurance companies to enter the market in a more meaningful size. I'm sure there's solutions around it, and you also structured around it. It is doable, but it's more tedious, it's less straightforward, so it demands definitely more work. Let me stop here.
Well, I think you raise a very interesting point, and it's the fact that regulations have created distortions in the market and drive basically demand into certain asset classes. You see that in Europe with Solvency II, matching adjustment is a specific feature of the UK market. You see that in the US as well with the NAIC rules. And you start comparing NAIC rules with Solvency II and so on, and you clearly say, well, this asset fits much better into an NAIC balance sheet. This asset fits much better into a Solvency II balance sheet. You take a 7th lien mortgage, it actually at 100% LTV. Well, guess what? NAIC rules don't care whether the mortgage is 1st lien, 2nd lien, or 10th lien. As long as it's a mortgage, it's a mortgage. 100% LTV is the same as, I think, as 10% LTV. You get exactly the same regulatory capital charge. You take it to Europe, it doesn't work the same way. You go into Europe, you have a mortgage that is owner-occupied, fantastic. It's a buy-to-let property that is not owner-occupied. That's not a mortgage for Europe under Solvency II, but it's a mortgage for NAIC rules for US insurers. So immediately you start to find, well, actually this is directing flows into different things. Probably unintended, but actually creates all these distortions. You go into Bermuda rules, they're different on top of that, so it creates a lot of interesting situations.
That is actually very interesting because, I mean, like when I hear you, the first thing that comes to mind is that market dislocation means that certain assets are overpriced, some are not, just because the market is not a free market as we've learned in classes. It means that the flows are driven by the regulatory, effectively, framework. By the way, across banks, insurance companies, we touched upon that earlier on. So my question is, do you see, and by the way, this year, more than ever as well, we didn't talk about it, but we start to see as well articles or discussions where investors may express concerns in terms of the relative value or the risk-adjusted valuation of some asset classes. In other words, do you see some like overrated asset classes in private credit? Frank?
I can start, maybe again start with corporate direct lending. I'm not sure if it's overheated, but it's crowded. I think that's my biggest concern, especially in the kind of middle market space. I think we also actually looked at acquiring a party to grow further in our field and do it for the general account and for third-party clients. I think McKinsey came back with a list of 180 parties, which would fit our kind of requirements, AUM between, I think, 500 million and 3 billion or so. So it is a crowded space. Obviously, you have to scramble for transactions, especially when the private equity market is a bit calmer, as we just heard. So less transactions being done. Everybody raised their funds, want to be deployed. No AUM on the management, there's no management fees. So there is always a kind of tendency to win. So you do see covenants loosening, you do see spread tightening. So I think that market is, well, not saying it's not offering relative value, but definitely it's a bit less in my mind than it used to be a couple of years back. The other thing is, like the big guys, like an Ares, I think they raised now 34 billion, I think, European direct lending fund, which is obviously a mega achievement, so applause to them. But I think if they start investing, I think they are not looking at 50 million clips if you have a 30 billion fund. So they will be looking at transaction of $1 billion or more. In my mind, that will have direct competition with broadly syndicated loans, which are liquid and is also relatively easy to place. Again, CLOs is also hot and they will take it down quite easily. So my question would also then be, what is the relative value of these kind of huge loans? Because the company has a choice, go to a big party, not maybe say calling names, but how much additional yield can you ask above a liquid leverage loan? And how many additional covenants can you ask if the whole broadly syndicated loan market is completely covenant light, there's no covenant whatsoever? So these companies obviously have a choice not to go to these direct lenders and pay up and have all these nice covenants. They can also go again, to the broadly syndicated loan market. So from a CFO perspective, I'm sure that these big direct lenders do extremely well. They get nicely paid, and a billion probably also costs you 6 weeks to close. On our side, actually, we are the opposite side. So we do very small tickets in the Netherlands. Subordinated loans, typically 5 million, also cost us 6 weeks to close. But I think there the competition obviously is much less because these companies don't have an alternative. They can't go to a liquid market. They can't go to somebody else. So I think the market there, from an investor perspective, does offer you better relative value. But obviously it's less scalable and therefore also from a CFO perspective, less profitable. So summarizing, I think the middle market is the biggest one. Everybody wants to have unit-trust lending, but it's pretty crowded. Upper market, I think that's where the flow is. And also for the fundraising, let's be honest, if you give your money to Ares or Hayfin or to Apollo, nobody will challenge you and will fire you for it. Going to specialty lenders on the bottom, you probably find better relative value if you look carefully and choose the right party. But obviously there, it is a bit more niche.
Maybe I think talking on the asset-based lending, aside from the corporate lending, what I would say is certainly the regulations are introducing distortions, like the matching adjustment in the UK means that certain insurance balance sheets are going to be focusing on certain assets with a very stable cash flow, predictable cash flow, etc. You see that in things like social housing and so on. What we also see is that on other parts of the market, the willingness by insurers and not only insurers but all investors to participate into the asset-based lending or asset-backed lending is also pushing the envelope a bit on risk. And one of the things that we do when we price and look at the relative value between all these assets is not just what's the basis points spread you're getting today, but what's the return in a bad day. Because as an insurance balance sheet, obviously you care much more about what's your downside than what is your expected base case. At the end of the day, we have money from pensioners, etc., that need to get their capital for sure when they retire, and they need to make a decent return. So certain asset classes, asset-backed asset classes, mortgages, etc., fit very well in there. You have relatively downside protection. And can get comfortable in those events. What we're seeing more and more is a lot of the, say, fringe asset classes that started to also get a lot of attention from investors in asset-based lending, where your return today may be good or decent, your downside is not that much protected.
Yeah, I would almost echo it. I think also the remark what you just made, or another panel, that the US structured finance market is 13 trillion, and the European market only 1 trillion, which is true. But if you then zoom in, what actually is securitized in the US is obviously it's all prime mortgages, which are all basically government-backed, and that's about 8 trillion out of the 13. So it's essentially government risk with 10 basis point yield pickup. And the other part is also agency CMBS, so basically property financing. I think that's also a couple trillion. So I think what is left, which I would really call asset-backed with a kind of credit risk on and yield on it, yeah, in my mind, but I'm European, I find it mostly crap collateral, because you need to talk about second lien mortgages, shipping, containers, all the stuff that you say as European doesn't give me a very warm feeling. So obviously you have to really look carefully what is the collateral. Indeed, residential mortgage, I would say, I think we all agree on. If it's prime residential mortgage, I think that's one of the safe asset classes out there, at least in Europe for sure. Other asset classes, we have to see actually how it behaves, and also if it's tested. I think there's been a lot of fintechs that obviously grow up. They start doing very small scale. They go a bit bigger, go to private ABS or get bank funding. In the end, they go to the public securitization market. It's obviously fine. I think one thing to be careful of is how do they scale? If they scale up, can they keep the, I would say, the track record and also the quality of assets? So how scalable are the underlying types of assets you originate, which can not always be unlimited. And I think the second is also how do you actually deal with delinquent loans and so on. So your funding circle, great party, you can save, all goes well. But if you have 10,000 loans, who takes care of these loans in a downturn cycle? So who can do the workouts? Who can negotiate terms again? So I think that is also something to take care of. Are there the right people in these kind of platforms that actually can take care of your assets in a downturn? And that actually comes down to your risk perspective. How does it behave in a downturn?
No, I think it makes a lot of sense. As a matter of fact, when we look at what is the role of the insurers are playing and can play in private debt, and of course, the question is that you guys are financing what the bank were financing, of course, before, or they're still financing, but financier of the long-term economy, but not a bank. My question is, like, when it has been an environment that has not been fully tested from a credit cycle standpoint. It's been 10 years plus of Eldorado for credit. Of course, things will start to, to be a bit more normal, quote unquote. My question is like, you will see default in some of your portfolio as the insurance company, as the investors take corporate. Are you willing to take the keys? What will happen? How does it work in real practice? Because I think we are very, very general in what we say. Today, it's normal. We're talking about an asset class, but private credit can take different form, number one. Number two, in real life, when you have like a default, what happens? What is the governance with the insurance companies? They are more stringent than, of course, an asset manager, fund, as far as the regulation is concerned. What is, the process around that?
I'd say, at least in our case, we're very much hands-on. We're happy to roll up our sleeves. At the end of the day, Apollo is managing the assets for the insurer's balance sheet. So if there's a default on a corporate loan, we're going to step in and look at the situation. If there's a default on a mortgage portfolio, we're going to speak to the servicers again and work out the trends that are happening in our portfolio. How can this be reversed? And obviously, we also own platforms, so there we control directly what's going on. So we're pretty much on top of all that.
Yeah, first I would say relatively similar story. So back to the mortgage business that we have. So that's, I think, 400 people that actually run it. So did work out some delinquent mortgage. I think it's obviously core business, and that's just people in-house that will do it. So like a bank, I would say there is not necessarily a concern. In the direct lending, again, we have two strategies here that we run. One is a co-lending strategy alongside banks. So it's not that we are the sole lender, but essentially we are part of a small consortium, not syndicated, but basically 3 or 4 banks and us do it together. Obviously, then you can team up and actually do the workouts, and I think that has obviously benefits, either in cost sharing or in just the strategy. The other thing we run is a subordinate loan fund that only does subordinate loans, so recovery will be 0 typically. So no big work needs to be done on getting collateral back. But in that strategy, we are partnering up with the European Investment Fund, so where we have guarantees from them. So if you have a default in those loans, you get 50 cents on dollar back from the European Investment Fund. Thanks for a small premium. So essentially, it makes it a senior loan. So in our case, that makes it relatively easy. But for unitranche lenders, indeed, it is definitely a concern. So are they willing to take the keys and run the company, or it's always in liquidation mode and you have to see what you get back? And I think for unitranche lending with relatively high leverage, I think recovery rates will not be 80 cents on the dollar. I think that's rather like 40 cents, 30 cents if you're lucky. So it probably is more akin to a bond, I would presume. If you really go to liquidation phase, but running a company as a direct lending fund and really playing private equity as a private debt fund, I think that is untested. So let's see who is prepared for that and who is not.
But I'd like to go back to something that you said. It's about the macro environment that we live in. I mean, we've been through a very benign macro environment for a very long time. Then came COVID, and then came a deluge of money to make things even better and rosier. But now we're in a situation where obviously rates are going to stay higher for longer. I think we all agree. And not only that, we just had Liberation Day a few weeks ago, and we have 4 more years of potentially more Liberation Days. So we're already thinking, what's the next thing that can happen? And there's more opportunity, or let's say room for the downside than for the upside. So I think being defensive in this context is quite important.
But do you think on that note that because when you see the spreads right now, I mean the response rate of the market, at least public market, but even the private market as a bank, we've been looking at, like we were talking about fund financing, we are discussing actually with the team on NAV on credit assets. I mean it's even tighter than what a AAA middle market CLO would pay. So you're like in the market seems a little bit sometimes off. And do you think like given where we are these, and given again the amount that has been raised and to be deployed in this asset class, do you think that the spread will still in a way normalize and you'll see opportunities? What's your view? What's your investment case in the next few months and maybe years? Who knows? But
my crystal ball is not working today, unfortunately. But I mean, we certainly think spreads are way too tight. I mean, that's across the asset classes, and especially when you look at the spread construction and the spread curve, it makes no sense that from AAA to BBB you have like 60 basis points in some markets, and you basically see, you look at the capital cycle, you see a AA, single A, BBB, 10 basis points apart one from another. That's not proper reflection of underlying intrinsic credit. So those are things that can happen in the market when you have imbalance of the demand and supply, and can last for a long time as long as that imbalance stays there. But effectively, at some point, it's going to have to return to the mean. Hopefully, not too soon. But it's the more risk for one side than for the other, I would say.
Frank?
Yeah, I would say typically it's relative value. So I would probably agree that obviously the absolute spread levels have been high in the past, so that's no surprise. But obviously there is still in the current market also some relative value, I would say, especially compared to the normal corporate credit, so the liquid corporate bonds and high yield bonds and govies. So either in private markets you get still, I would say, a relatively decent yield pickup. But some other things we like a lot, and also our clients like a lot. Again, come back to the residential mortgages. You get 200 basis points over govies, and I think we have run the fund now since 10 years, and I think as Aegon 50 years, the highest loss ever was 6 basis points. In the last 10 years, cumulative loss, less than 1 basis point. So it behaves, I would say, like a govie, but you would still get a, I would say, pretty decent yield pickup. And also I think in liquid ABS and also private ABS, CLOs, 120 over AAAs and 350 for BBBs, I would say, hey, not a bad number, diversified across different things, still liquidity obviously present. You can still make 150, 200 basis points for a strong investment grade portfolio. And if you go only to Europe, 0 defaults ever, at least in such a strategy. So I would say there is still good relative value compared to corporate credit. But would I love corporate credit as yield levels? Some other things also. Obviously, there is spread widening potential. But yeah, what has happened, I would say the world is on fire and still spreads don't really blow out. So what needs to happen before it really happens? I think people now have too much belief in ECB steps in, everybody steps in, and it will all be fine. So I think the real risk and maybe the mega blow somehow is completely disregarded. But also, to be honest, if you're underweight risk and you run against a benchmark, I think, yeah, you might also be wrong for a couple of years. Clients might be dissatisfied, they go away. So to go against the market might also be very painful, especially what you say. The market might be at this level for a long time. And then I guess you have to actually follow the crowd.
Interesting. Bon, we need to be, it's going to be interesting to navigate. I'd like to come back on, we talked about like the convergence public-private. That's actually your CEO, Mark Rowan, is saying exactly that. As a matter of fact, as the loan market, developed and the rest of it, what you say as well is with the liquidity illusion in a way that would be actually maybe the public market are in some way are too expensive. If I read you correctly, I guess the question I have is that what do that mean for insurance balance sheets if we were to start to trade some more commoditized type of asset classes? Is there any impact to have to start to have like a potential market valuation? What does that mean?
Yeah, I think it's now often very seen as black and white, with public markets are liquid and private markets are illiquid. I think also Rowan has actually expressed also in some YouTube movie. I think he nicely said that if you look at the market making capacity of investment banks, I think it's down to 10% of 2007 levels, whereas the overall outstanding AUM of liquid credit is probably 3 or 4 times the 2007 level. So essentially the market making capacity of investment banks is only 3% of 2007 levels, implying that also liquid market, if you want to get out, banks can't be the liquidity provider. You have to go to somebody else, everybody on the same side. Again, it is also illiquid in nature. So I would say liquid markets are not that liquid as people might actually imply. On the other side, you see private markets. If it's indeed more investable and more people will invest in it, obviously it becomes, more easily tradable. Take something close to my house, social housing loans. I think they're all kind of standardized. Yes, they're private because everybody's the same. They become relatively liquid. You can actually trade out of it with a couple basis points bid ask. Private placements of investment-grade private placements, typically 10, 15 investors in it. Again, if you want to get out, pretty sure you will find a bid. And you can get out going to at some point in the funds, and we haven't spoken about LTAFs and other stuff, but if many people invest in the same funds at some point in time, because everybody is kind of guided in the same kind of semi-open-ended evergreen funds, and you have, I don't know, 10, 50, maybe in the end 100, 200 third-party investors, you can almost make an internal market that somebody wants to get out, and maybe somebody else wants to add to their position. They know the fund, they follow it all day long. So that might also actually generate a bit more market liquidity in a pure private debt fund, in an open-ended evergreen, so to say. So not black and white, I would say. So back to your question, if indeed insurance companies start believing, and maybe also regulators start believing that illiquid is not really illiquid, obviously there is potential that people invest more in it. Though obviously you have to be careful about accounting reasons and all those kind of things. So insurance companies typically don't like open-ended funds where all things is traded. So then you need to solve some other issues as well.
Yeah, I totally agree. I would say that at the end of the day, why do insurance companies invest in private credit? Just because they don't need the liquidity. Because the beauty of the insurance balance sheet is that you have 30-year liabilities. So you have the luxury of being able to invest in things for 10 years and not care about whether it's liquid. As long as it's performing, you don't really care whether the mark is here or there. Because if you're matching your assets and liabilities and have the same type of exposures, your assets and liabilities are marking at the same level. So you're always matched. So from that perspective, we are not doing the transformation that banks or other investors do. If you have a fund that has daily redemptions, etc., you need obviously to have liquidity to invest in 5-year loans, let alone 30-year loans. If you have liabilities that are 30 years, you are quite comfortable there.
Yeah, but that's interesting. I think we are about to run out of time, but it's interesting because that's where, again, for me, my takeaway is that today, yes, we see this. At the same time, we are saying like the next frontier to grow this business, to grow this asset class, is the retail. Retail, you need liquidity. Would the liquidity start again to, quote unquote, start to to mark to market those assets, and then the impact on the incumbent investors? I think the market is in flux in a way that we are not fully sure with how the market will develop in the next few, because there are some contradictions. You see what I mean?
I don't disagree with you. I would question whether retail needs liquidity. Yes, everybody wants to have liquidity, and everybody wants to be able to sell tomorrow. But when you think about actually how many people trade in and out every day in retail, it's not that much. So could you do something, perhaps?
Yeah, interesting. I guess we're out of time now, so up to any Q&A. Christina, please.
Yes, thank you very much. A great applause to you first. Thank you.